Many taxpayers discovered their foreign bank account reporting problem years too late. A foreign bank account, an inherited overseas account, a foreign pension, or merely having signature authority over an offshore account of somebody else. A lot of times people don't realize that these have to be reported on an FBAR. Their first instinct is often simple. Let's go in and file the missing FBARs and move on. Listen, that decision alone can be dangerous, because the wrong filing strategy can create far more problems than the original non-filed FBARs. Let me explain. Hi, I'm David W. Klasing. I'm a dual licensed tax attorney and CPA, and I'm the owner of the tax law offices of David W. Klasing, 23 offices in 11 states to help you with this problem. Today I'm going to explain when delinquent FBAR submission procedures apply, when they don't, and how choosing the wrong offshore compliance path can dramatically increase your civil and criminal tax exposure. So, what really is an FBAR? FBAR stands for Foreign Bank Account Report. It's talking about FinCEN Form 114. It's filed electronically, annually, through the Bank Secrecy Act filing system. Generally, U.S. taxpayers must file when the aggregate value of foreign financial accounts exceeds $10,000 at any point during the calendar year. More importantly, the account does not need to generate taxable income to require it to be reported on an FBAR. A lot of times, foreign pension plans don't generate currently taxable income. So, when do the delinquent FBAR procedures apply? The IRS created the delinquent FBAR submission procedures for a narrow group of taxpayers. To qualify, generally the taxpayer must not be under a current audit or criminal tax investigation, and can't have been contacted by the IRS regarding the missing foreign bank account reporting. Most importantly, they had to report all taxable income associated with the offshore, and they had to properly report all taxable income associated with the foreign financial accounts. This is often called in the profession the FBAR only problem. So, when is no penalty relief available? The no penalty benefit is narrower than most people realize. The taxpayer generally must have reported all foreign financial source income, paid all tax due, and simply failed to file an information report. In those circumstances, a delinquent FBAR submission may provide a relatively clean path back into tax compliance. When are the delinquent FBAR procedures the wrong choice? Many taxpayers and sometimes their advisors assume every offshore problem can be fixed with a late FBAR filing. First of all, they're going to hit you for $10,000 for each one filed late if you don't qualify for the penalty relief. Anyways, this is not true. The procedure is inappropriate when foreign income was omitted. Schedule B was answered incorrectly, Form 8938 was not filed, or the facts suggest intentional concealment. At that point, a different compliance strategy may be necessary. So let's talk about streamlined procedures versus delinquent FBAR filing. Taxpayers frequently confuse delinquent FBAR procedures with the streamlined filing compliance procedures to fix the non-disclosure of offshore accounts. These two programs are not the same. Streamlined procedures require certification that your conduct was non-willful, that you didn't ignore the law. The certification is signed under penalties of perjury. If the facts of your case suggest willfulness, recklessness, or intentional concealment of offshore accounts, the certification itself can be extremely dangerous. The IRS has a full-blown voluntary disclosure program for offshore accounts. In high-risk cases, this program may be the safer path into compliance. This is especially true when your facts involve large amounts of unreported foreign income, the use of numbered accounts, the use of nominee entities, if there's a lot of account transfers, especially after learning of IRS enforcement, or there's evidence suggesting knowledge of the reporting obligation yet ignoring it. The key here is matching the compliance strategy to the actual facts of your case. So in closing, if you recently discovered missing FBAR filings, foreign account reporting issues, or you've discovered unreported taxable offshore income, you should not assume that simply late filing of the forms is the correct solution. At the tax law offices of David W. Klasing, our dual licensed tax attorneys and CPAs routinely help taxpayers evaluate FBAR compliance options, streamlined procedures, voluntary disclosures, and we routinely deal with high-risk offshore tax matters. We're doing that all the while minimizing civil and criminal tax exposure. Call 1-800-681-1295 or visit KlasingAssociates.com to schedule a confidential reduced-rate initial consultation today. Offshore compliance issues are at times between 40 and 60% of our book of business. We've been dealing with it since 2009. We can fix it. Dave Klasing, Tax Attorney and CPA.